India's corporate liability insurance market is undergoing a structural expansion, growing faster than the general economy, driven by tightening corporate governance and escalating digital exposure. Comparing India's liability insurance penetration against global peers, it sits at just 0.3% of GDP, trailing emerging markets like Thailand and Malaysia. Bridging this gap to reach Thailand's 0.8% level requires creating a $7 billion incremental market. The insurance regulator, IRDA, has formalized this trajectory with its Insurance for All by 2047 framework. The stated target is to push overall non-life penetration to 2.52% by fiscal year 2027. This multi-billion-dollar premium expansion yields a highly specific mathematical outcome for intermediaries. Based on current market shares and commission structures, this translates to an immediate $132 to $198 million annual revenue opportunity for brokers who build the infrastructure to capture it. This surge in demand is not organic. It is mandated by specific legislative actions that impose strict financial consequences on corporate boards. This timeline maps the three major regulatory catalysts. The first is the Digital Personal Data Protection Act of 2023. By establishing a 250 crore rupee penalty framework for data breaches, the act forces companies to adopt cyber insurance as a necessary risk transfer mechanism. The second catalyst is the Consumer Protection Act of 2019. Section 84 explicitly introduces strict liability into Indian law. Manufacturers are now financially liable for defective products, regardless of negligence, driving immediate demand for product liability coverage. The third catalyst comprises the Companies Act 2013 and SEBI mandates, drastically expanding personal exposure to regulatory actions and shareholder claims. For India's thousands of listed entities, SEBI has made directors' and officers' insurance a mandatory requirement to operate. These frameworks leave corporate entities with a binary choice: absorb catastrophic financial penalties on the balance sheet, or transfer the risk to the liability insurance market. Acquiring this new premium volume is only the top-line equation. A broker's placement leverage, the ability to negotiate favorable terms, depends entirely on bringing profitable business to insurers. This matrix breaks down the combined ratios across major liability lines. The industry average operates at a structural underwriting loss of 110%. To maintain leverage, brokers must target the lines that offset these losses. Cyber insurance at 98% and professional indemnity at 99% fall into the green zone. They generate underwriting profit. Brokers who bring this specific business to insurers secure highly competitive terms and broader limits for their clients. Conversely, workmen's compensation sits in the red zone at 107%. It generates massive premium volume, but faces severe underwriting pressure and rate scrutiny due to long-tail occupational claims. A broker portfolio heavily weighted towards loss-making policies limits negotiation power. Insurers will restrict capacity and tighten pricing on underperforming books of business. Building a resilient brokerage requires a targeted acquisition strategy. Lead client conversations with high-margin cyber and professional indemnity products to anchor your book's profitability. We can quantify this exact opportunity by calculating the protection gap. We take the total number of firms in a sector, multiply by average revenue and the standard insurance rate, then subtract the current written premium. Apply this to India's IT and IT-enabled services sector. There are roughly 45,000 companies operating in this space. Even with a relatively high market penetration of 42%, the massive scale of the IT sector leaves a 58% blind spot. That is an untapped cyber insurance gap of 1,646 crore rupees. A different dynamic drives the pharmaceutical sector. India houses over 10,000 pharma manufacturers, many of which export to the US and EU markets, where strict liability coverage is a prerequisite for entry. Yet, awareness of these export requirements remains low. This results in an 85% penetration gap for product liability, equating to 714 crore rupees in unwritten premium. Between just the IT, cyber, and pharma product liability sectors, there is over $530 million of incremental premium ready to be underwritten today. To capture this premium efficiently, brokers must move away from transactional, single-product selling and deploy structured cross-selling based on sector specialization. This waterfall chart demonstrates the financial mechanics. We begin with a baseline manufacturing client purchasing a single workman's compensation policy. This represents a 1.0 revenue multiplier. By adding a directors and officers policy to that same account, the broker elevates the commission yield to 1.6 times the baseline. Stacking product liability and cyber coverage completes the sector bundle. The revenue multiplier reaches 3.2 times the original commission on the exact same client relationship. Transitioning to a 4-product bundle drives down the customer acquisition cost while tripling the lifetime value of the account. The math rewards specialization. This matrix maps the exact structural blind spots causing the protection gap. The red zones indicate severe underinsurance, specifically in the SME and FMCG brackets. In mid-market manufacturing, the current penetration for directors and officers insurance remains well below 20%. This is driven by the false assumption that private companies without shareholders face no director liability. In reality, regulatory actions and creditor claims apply regardless of corporate structure. In the SME sector, cyber penetration sits below 2%. This is an operational failure. Traditional cyber underwriting requires dense IT security audits that small businesses simply cannot process. Acquiring a meaningful share of India's 63 million MSMEs requires brokers to build digital pipelines. Success here relies on simplified, low-questionnaire products that can be quoted and bound instantly online. As distribution digitizes, direct placement portals and aggregators will attempt to commoditize the transaction. The broker's defense mechanism against this is a robust internal claims advocacy team that resolves complex liability disputes on behalf of the client. Executing this strategy requires evolving the brokerage model. Relying on manual placement is no longer viable. The modern broker must deploy automated digital acquisition for SMEs, paired with highly technical claims advocacy. The structural expansion of the Indian liability market is actively underway. As international players enter through 100% FDI channels, the window for domestic brokers to establish dominance is closing. This 24-month roadmap outlines the necessary operational pivots. Execution begins with immediate quick wins, cross-selling D&O and product liability to existing accounts, and scales systematically toward developing parametric coverage models and deploying comprehensive data analytics for renewals. Generalist placement is yielding to sector-specific risk advisory. Corporate clients require partners who understand the distinct regulatory pressures of their exact industry. With compliance frameworks tightening and personal executive exposure rising, the multi-billion-dollar premium gap will be captured exclusively by brokers who operate as specialized technical advisors. PIB Insurance Brokers provides the specialized expertise necessary to audit your operational risk, navigate the regulatory landscape, and architect precise corporate liability coverage. Secure your balance sheet today.